Hey everyone, let's talk about something that affects your finances more than you might realize, the 10-year Treasury yield. Sounds complicated, but don't worry, I'm here to break it down in a simple way. First off, the 10-year Treasury yield is basically the interest rate the US government pays to borrow money for 10 years. When people buy these Treasury bonds, they're essentially lending money to the government. Now here's why it matters. The 10-year yield is often considered a benchmark for other interest rates. And that includes, yep, you guessed it, mortgage rates. So if you're planning to buy a house or refinance, this little number is something you want to pay attention to. When the yield on these bonds goes up, mortgage rates tend to go up too. Why? Because when the government has to pay higher interest, lenders also raise rates to keep up. This means higher monthly payments if you're looking to buy a home. But when the yield drops, mortgage rates often fall too, making it cheaper to borrow money for that dream home. That's why changes in the 10-year yield can directly affect your budget. So, what drives the yield up or down? Things like economic outlook, inflation, and even global events can cause changes. The Federal Reserve's policies also play a big role, so when you hear about rate cuts or hikes in the news, that can affect the 10-year yield too. To sum it up, the 10-year Treasury yield is a key indicator of where mortgage rates are headed. Understanding it can help you make better financial decisions, especially if you're in the market for a new home. Thanks for watching. If this helped, hit that like button and subscribe for more quick, simple breakdowns on how the market works.